Holding PayPal stock has not been easy for investors. The stock is down about 80% from its all-time highs, and if you bought the stock a year ago, you must be frustrated to see that PayPal stock has not recovered at all, while the broader markets rally off their bear market lows. And recently, the company reported weak Q2 results, which led to the stock crashing more than 10% the next day. So it's been frustrating for PayPal shareholders, including myself. But the question remains, is PayPal stock a buy or is it a value trap? And that's what we'll be talking about in this video. We'll cover PayPal's Q2 results, its valuation, and whether the stock is a buy or not. Also, you can find the link to the article version of this analysis in the description below, so definitely check that out. And with that out of the way, let's take a look at PayPal's Q2 results. Now let's first look at the growth of the company. Q2 revenue was $7.3 billion, which is up 7% year over year, and despite the slight beat on analyst estimates, you can see that growth has slowed down to a level that really threatened the company's growth story. Years of growth have been pulled forward in the early days of the pandemic, and now PayPal is behaving like a maturing company, no longer the fast-growing fintech stock that investors love. Breaking it down by segment, you can see that transaction revenue, which make up the bulk of PayPal's revenue, was $6.6 billion in Q2, which is up only 5% year over year. So transaction revenue growth was mainly driven by an increase in total payment volume and the rapid growth of unbranded processing, offset by a slowdown in PayPal's core products and services. On the other hand, other revenue, which consists of only 10% of total revenue, grew by 37% year over year, mainly due to increased interest income on customer store balances. But the concern here is that PayPal's primary revenue generator has not been picking up over the last few quarters. That being said, overall revenue growth was due to the growth of total payment volume, or TPV, which was $377 billion in Q2, which is up 11% year over year. As you can see, TPV growth re-accelerated in Q2, driven by PayPal branded checkout, Venmo, and Braintree. So according to management, PayPal branded checkout grew mid-single digits with acceleration throughout the quarter. Venmo grew by 8% year over year to $67 billion of total payment volume, and Braintree, which is the unbranded processing side of PayPal, grew by 30% year over year. And you may have noticed that TPV grew much faster than transaction revenue, more than double the pace actually, and this is due to the slowdown in branded processing as well as the strong growth in unbranded processing. As you can see, PayPal branded transactions like PayPal, Pay Later, and Venmo charge merchants with a fee of 3.49% per transactions, while unbranded processing only costs 2.59% per transaction. So as a result of the rapid growth in unbranded processing, PayPal's take rate has been trending down over the last few quarters, and recently in Q2, PayPal recorded the lowest transaction take rate and total take rate ever at only 1.7% and 1.9% respectively. The declining take rate is a symptom of poor monetization within the business, and this is possibly the single biggest reason why investors were not happy with PayPal's Q2 earnings results. And to make matters worse, active accounts continued its sequential decline. PayPal ended the quarter with 431 million active accounts, which was 2.5 million active accounts less than Q1 due to churns of minimally engaged accounts as the company shifts its focus on driving higher engagement with existing accounts. And this has been management's plan for the past year, so this is expected, and the reason for this is that management wants to focus on quality over quantity, or higher ROI accounts over those that don't really drive engagement or transactions within the platform. And that is reflected in the growth of the other two metrics. So while active accounts continue to drop, number of transactions and transactions per account continues to grow, as you can see right here. So in Q2, the number of payment transactions grew 10% year over year to 6.1 billion transactions, and transactions per account grew 12% year over year to 55, which means growing engagement within the platform. All in all, it's obvious that PayPal is no longer a rapidly growing fintech company, but I still believe that PayPal is a high-quality business capable of posting consistent growth of at least 8% over the next few years. However, there were a few things in the report that raised a few yellow flags for me. First, transaction revenue is growing very slowly at just 5% year over year, and if transaction revenue declines year over year, that's a thesis breaker for me. Secondly, take rates are also declining, which could mean price competition or monetization issues within the platform, and if take rate rates continue to decline, that could be another thesis breaker for me. Turning to profitability, transaction profit or gross profit was $3.3 billion in Q2, representing a 46% gross margin. So just like take rates, you can see that gross margins have been decreasing over the last few quarters due to unfavorable product mix with more TPV generated from unbranded card processing, which typically has higher expense rates than PayPal's branded processing products. And given the rapid growth in PayPal's unbranded payment processing business, I expect gross margins to continue to decrease in the short term. On the bright side, according to the CFO during the call, it seems that Q2 could be the bottom and we could see gross margins improve in the next few quarters, so that's something to look forward to. Moving on to operating profit, in Q2, GAAP operating income was $1.1 billion, which represents a 16% GAAP margin or a 21% non-GAAP margin. So despite gross margins declining year over year, operating margins actually improved year over year, as you can see right here. And this is due to non-transaction related expenses being down 11% year over year. And this reflects the company's cost and productivity initiatives, which more than offset the decline in transaction margins. So that's really great to see. Net income also improved year over year, as you can see right here. And net income for Q2 was $1 billion, which represents a 14% GAAP net margin or an 18% non-GAAP margin, which is higher than last year's number, so that's great to see as well. As a result of improved profitability, earnings per share is showing robust growth. I've used non-GAAP numbers here as it excludes net gains from strategic investments, which distorts GAAP numbers. As you can see, non-GAAP earnings per share was down 10% year over year in 2022, but the company turned it around and produced 33% and 24% non-GAAP EPS growth in Q1 and Q2 respectively, which means PayPal is still generating shareholder value. So hopefully the company keeps this up, and if they do, the stock price should eventually follow earnings per share growth. With that being said, as I've mentioned in my previous video, PayPal's gross margins are declining, which shows diseconomies of scale, while operating margins are improving, which shows operating leverage. So I'm feeling pretty neutral about PayPal's profitability. The issue is, how can PayPal generate strong, consistent earnings per share growth if revenue is slowing down and gross margins are declining? I think that will be very hard to sustain, and I think that's the most frustrating part about PayPal. Turning to the balance sheet, PayPal ended the quarter with $9.9 billion of cash and short-term investments, with a total debt of $10.5 billion, which brings its net cash position to be about negative $0.6 billion. Ideally, I like to see positive net cash balance, but PayPal is still in a strong financial position given its strong free cash flow profile. Well, that may not be the case because free cash flow turned negative in Q2, burning $350 million of cash. So yes, after years of consistent positive free cash flow, PayPal is now burning cash and destroying shareholder value. So how can PayPal be in a strong financial position if the company is burning that much money in a single quarter? Well, the negative free cash flow this quarter was due to a $1.2 billion negative impact from European buy now pay later loans originated as held for sale, which is expected to be sold in the second half of the year. So without the HFS impact, free cash flow would have been $869 million in Q2. But the point of this transaction is to de-risk PayPal's balance sheet and makes PayPal more capital light, as well as generate $1.8 billion of proceeds, which will be recognized in cash flow from operations upon closing. So while there are a lot of moving parts in its cash flow statement, there are no material changes in PayPal's free cash flow outlook in 2023, so just keep that in mind. And with that cash proceeds, PayPal intends to allocate them for additional buybacks, $1 billion worth to be specific. As you can see by the orange line, PayPal has been buying back shares aggressively. On a trailing 12-month basis, PayPal has bought back 63 million shares worth $4.9 billion, and in Q2 alone, the company bought back $1.5 billion worth of shares. As a result, share count is falling off a cliff, and given the current stock price, I expect PayPal to continue to buy back shares aggressively, which should accelerate earnings per share growth as share outstanding continue to decrease. Now let's discuss the outlook of the company. So management expects revenue of $7.4 billion in Q3, which is up 8% year over year, and management also pointed out that revenue is accelerating in July, growing 9% year over year, and TPV is also growing in the low teens, and branded checkout TPV is growing at 8% year over year. So that's great to see. Next, non-GAAP EPS is expected to be $1.23, which is up about 13.5% year over year, which is also faster than revenue growth, as you can see right here. So I'm assuming margins will improve and the share buyback program will have an impact on EPS growth as well. For full year 2023, management expects revenue growth in the second half of the year to be at least in line with the first half of the year. Non-GAAP EPS is expected to grow by about 20% year over year to $4.95, which is very impressive. Non-GAAP operating margin is expected to expand by at least 100 basis points, which means a non-GAAP operating margin of at least 22% for full year 2023. Free cash flow is expected to be $5 billion, and all of it will be used for share repurchases, which is expanded by $1 billion to $5 billion. And finally, CapEx will make up around 3% of revenue. All in all, there's nothing that really caught my attention from the guidance. Management basically reiterated their full year guidance, and I think the markets were expecting a little bit more, perhaps a raise in revenue or EPS guidance, but unfortunately we didn't get any, and I think that's another reason why the stock sold off. Aside from that, I like that EPS is growing at double digits. Free cash flow is expected to be strong, and the company is accelerating its share repurchase program, which is great to hear. In other news, CEO Dan Schulman gave an update on the company's search for a CEO replacement, and during the earnings call, he mentioned that the CEO succession plan is at the very final stages and that there are several high qualified candidates. No names yet, but I think it's about time to bring fresh management to really turn this company around. And I just want to mention this as well. One thing that's really overlooked by the markets is the fact that PayPal's payment service provider, or PSP, is rapidly growing at nearly 30%. This includes services such as Braintree for large enterprises, as well as PayPal Complete Payments for channel partners and SMBs. So management mentioned during the earnings call that many of the largest tech companies are expanding their integrations with Braintree, and that the company is seeing tremendous interest for PPCP. In fact, PPCP is now implemented with leading channel partners like Adobe, Shopify, and WooCommerce, with 25 additional partners expected to be live by the end of the year. I think the markets failed to realize the potential of PayPal's PSP business. While the rapid growth of PayPal's PSP is putting pressure on take rates and margins, PayPal is also rolling out higher margin value-added services, which should boost PayPal's overall growth and margin profile in the future. So I think PSP is going to be a major growth driver for PayPal, and that is something to be excited about. Turning to the valuation of the company, in terms of EV to revenue multiples, PayPal is trading at the lowest multiple ever at a multiple of just 2.4 times, which is well below its average of 6.7 times and its peak of 16 times. I think it's reasonable for PayPal to trade at about 5 times its sales, which is still below its average, but that's still 100% upside from today's prices. And in terms of PE ratios, PayPal is also trading at very low multiples at just 17.6 times its last 12 months earnings. For forward PE ratio, it's much lower, trading at just 11 times, which indicates rapid earnings growth in the next 12 months. So based on historical multiples, PayPal has never been cheaper. Now let's take a look at my DCF model. As always, for the first 3 years, I'll follow year-over-year revenue growth rates based on analyst estimates, and for the remaining years, I'll keep it at a growth rate of just 8% per year. So no acceleration or slowdown, so I think this is pretty conservative. I also expect PayPal to achieve an operating margin of 15% in 2023, which is in line with margins for the first half of this year. So I will set cost of revenue and operating expenses accordingly. Over time, I do expect operating margins to improve to 18.6% by 2032 as the company achieves operating leverage. As for income tax, I will set it at a constant rate of 20% of operating profit, and to calculate free cash flow, I will also be adding back transaction and credit losses, which PayPal adds back to calculate its cash flow from operations, since this is a non-cash expense. That said, I will use 5.5% as the starting point in 2023 and then improves to 4.6% by 2032 as PayPal's technology gets better. And for the rest of the items, I will set them at a constant rate like so, which follows previous year's percentages. Also, feel free to pause the video so you can take a better look at the numbers. So based on these assumptions, I expect revenue to be about $60.1 billion by 2032 at a free cash flow margin of about 20%, which is fairly reasonable. And assuming a discount rate of 10% and a perpetual growth rate of 2.5%, I arrive at an intrinsic value per share of $103 for PayPal. I think this price target is unchanged from my previous video on PayPal, and this is actually slightly higher than the average analyst price target of $90. So again, based on my DCF model, I think PayPal is severely undervalued with a potential upside of 64% based on the current price of $63, which is why I started a position in the company about a few months ago. The reason why I bought PayPal is because PayPal is a high quality business with strong competitive advantages, but I think fear is driving the prices down to deep value territory, and I think the sell-off is just overdone. But my take is, if you want to generate significant returns, you need to be buying beaten down stocks when things are going south and when things are uncomfortable, not when it's all sunshine and rainbows. Because when things feel bad, there's a lot of fear baked into the stock, and that's when the stock is usually trading at a massive discount to intrinsic value. Right now, you're going to hear a lot of negative things about PayPal, but the important thing is, can you look at the fundamentals of the business objectively rather than emotionally and decide whether the company can turn around or not? And in this case, in my opinion, I think PayPal can turn around and the stock price will eventually follow the earnings of the business, which is why I bought the stock despite all the fears. Quickly turning to the risks of the company, the first major risk for PayPal is of course competition. So this chart shows that PayPal is the leading digital wallet in the US in both online and offline transactions, with a market share of 36% and 29% respectively, with Venmo is also right up at third place, which is also great. But despite being the top dog in the fintech industry, PayPal still faces tough competition from other digital wallets like Apple Pay, Google Wallet, and Cash App, and platforms such as SoFi, Robinhood, and Affirm also pose a threat to PayPal. And that is probably what investors are really worried about, that competition will eventually eat away PayPal's growth and margins, which will lead to shareholder value destruction. And this is worth repeating again. The thesis breakers for me are that revenue growth and take rates decline year over year, which is a clear signal that PayPal is losing to competition. The second risk is management. Again, there's been a lot of changes with management over the last few years, so I'm still waiting patiently and anxiously for the new CEO to be announced. Until then, I think sentiment will remain poor for PayPal stock. So to wrap up this video, Q2 results show that revenue growth is decelerating, margins are declining, and the guidance wasn't great after all, which are all valid reasons why the stock sold off. And while everyone focused on the negatives, EPS is growing at double digits, TPV growth is accelerating, unbranded processing is rapidly growing, the company is buying back shares aggressively, and operating margins are actually improving. And fundamentally, I think PayPal is a high quality business with strong competitive advantages and long growth runway in the fintech space. That being said, investor sentiment is at an all-time low, and I think this creates a wonderful opportunity for investors to buy shares with a wide margin of safety. Well, that's all that I have for you today. If you find value in this video, please don't forget to hit like and subscribe so you won't miss future videos like this. As always, I appreciate you and I hope you have an amazing day. See you guys on the next one.